Bull and bear market, the real story of the stock market's two animals. One morning, a new investor opens his phone, and on the screen, the red and green numbers of Nifty and Sensex appear to be changing rapidly. His eyes get stuck between profit and loss. The stock that was showing a profit until yesterday is suddenly down today. In WhatsApp groups, someone is saying it's a bull market, while someone else is scaring others by saying the bear market has arrived. That investor gets confused. He doesn't understand why people have suddenly started talking about animals in the market when it is humans who are investing the money and humans who are feeling the fear. The fear begins right here. If the language of the market is not understood, an investor buys with the crowd, sells with fear, and can unintentionally increase his losses. And the curiosity is, why is a rising market called a bull and a falling market called a bear? After all, where did the bull and the bear come from in the serious world of the stock market? The share market is not just a game of numbers. It is a field of hope, fear, greed, patience and panic, where human psychology is tested openly every single day. When the market goes up, people feel that wealth creation has become easy. Confidence is visible everywhere, and new investors start making quick entries. Such an environment is called a bull market. It simply means that there is an overall upswing in the market, prices are going up, and the mood of investors is turning positive. In a bull market, it's not just stocks that rise, people's hopes rise too. Interest in IPOs grows, money flows into mutual funds, and excitement is visible on news channels. In common market language, when an index goes up by about 20% or more from its recent low, it can be called a bull phase. But this is not a magic line. The 20% rule in the market is a common reference, not a law. The real thing is the trend, the sentiment, and the direction of the economy. Now the question arises, why a bull? The answer lies in the way a bull attacks, which has been symbolically linked to the movement of the market. When a bull attacks, it lifts its horns from the bottom upwards. This upward movement was compared to a rising market. Similarly, when the market moves from bottom to top, charts go up, prices go up, and investor sentiment rises, it is called a bull market. In a bull market, optimism is the strongest fuel. People believe that the economy will get better, companies will earn good profits, and stock prices can rise even further in the future. With this hope, buying increases. When more people buy, demand grows, and when demand grows, prices get support, making the rally look even stronger. This very cycle often continues for a long time. Good earnings, low interest rates, stable policies and strong liquidity can give even more strength to a bull market. But a bull market does not mean that every stock will rise. The market can be up, yet shares of weak companies can fall or remain sideways. This is where new investors make the biggest mistake. They think that in a bull market you can buy anything and make money, and they ignore the risk. In reality, even in a bull market, understanding quality, valuation, and risk is essential. In a rally, a bad decision can remain hidden for a while because of a good market. Now let's come to the second animal of the story. When the market goes down continuously, prices fall, and investors' confidence begins to shatter, it is called a bear market. In a bear market, screens look red, portfolios shrink, and the same question is visible on people's faces. How much more will it fall now, and for how long will it fall? In the common definition, when the market falls by about 20% or more from its recent high, it is called a bear phase. But here too, just the percentage is not enough. How broad the decline is, how long it has been going on, and how weak the sentiment is, all of this is important. The word bear is also linked to an animal attack. When a bear attacks, it strikes its paws hard from top to bottom. This downward swipe was connected to a falling market. Just as the bear strike comes down, prices and charts are seen going down in the same way. In a bear market, fear is the strongest emotion. People think about saving capital, cutting losses, and staying away from the market for a while. Selling pressure increases. When more people sell, prices come under pressure, and the decline reinforces people's fear even more. This fear is often logical too. A weak economy, high inflation, rising interest rates, geopolitical tension, or poor corporate earnings can drag the market down. But sometimes, fear increases more than necessary. Good companies also drop in panic because the market runs on emotion in the short term. A bear market takes the real test of an investor. Everyone looks confident in a bull market, but the true value of patience and discipline is understood in a bear market. In India too, investors have seen many phases. Sometimes elections, sometimes a global crisis, sometimes rate changes, sometimes oil prices, and sometimes selling by foreign investors changes the market mood. Sometimes the domestic economy looks strong, but global signals shake the market. This is why the Indian market cannot run completely isolated from the world either. This is the reality of the stock market. India's companies can be strong, but the impact of crude oil, dollar movement and foreign flows is visible here as well. Therefore, bull and bear are not just words. These are symbols that explain the collective psychology of the market, through which investor sentiment can be understood in simple language. When the crowd is hopeful, the bull looks stronger. When the crowd is fearful, the bear feels heavier, and the voice of the market changes. An interesting thing is that within every bull market, small corrections take place, and within every bear market, temporary rallies are also seen. Therefore, not every decline is a bear market, and not every rally is a bull market. To understand the trend, both time and context are required. The market does not become a bull or a bear in a single day. The complete story of data, sentiment, money flow, and investor behavior is involved in making it. Many investors draw conclusions just by looking at the index. But a smart investor looks at which sectors are moving, how the earnings are, and whether the valuation is reasonable or not. The risk in a bull market is that confidence can turn into overconfidence. People start trading by taking loans, investing money on tips, and forgetting about safety. In a bear market, the risk is the opposite. People get so stuck in negativity that they fail to see good opportunities and run away even from quality stocks. Meaning, greed can cause a loss in a bull market, and fear can cause a loss in a bear market. In both situations, an emotional decision can be dangerous for an investor. Money in the market is not made just by prediction. Many times, money is also saved through patience, asset allocation, and by not panicking at the wrong time. For a long-term investor, both the bull and the bear are part of the journey. If the market always went up, there would be no such thing as risk. And if the market always went down, no investment culture could ever be built. Market cycles are like the breathing pattern of capitalism itself. Companies grow, make profits, the economy expands, then a slowdown comes, a correction happens, and then a new cycle gradually begins. The bull market is like that phase when the narrative of confidence, liquidity, and growth is strong in the economy and investors begin to believe the future will be better. The bear market is like that phase when doubts grow, valuations break down, and investors become cautious about the future. But a bear market is not always bad. Many times it brings overpriced stocks to a realistic level and gives a healthy reset to the market. Just as the body needs rest after running fast, the market needs a correction after a very long rally. Understanding the difference between a correction and a crash is also necessary. A correction is usually a minor decline, while a bear market shows a broader and deeper weakness. In a bull market, media headlines are shiny. Lines like "market at new high," "investor wealth increased," and "new records" run everywhere. In a bear market, the headlines change. Things like "market crash," "investors lose wealth," and "recession fear" increase people's anxiety. But headlines do not always tell the complete truth. They show the mood of the market, but they do not give the right strategy to the investor. An investor should look at his goal, not the headline. How long the money is to be invested for, how much risk is to be taken, and when it will be needed must be clear. If someone needs money in the next 6 months, a volatile equity market can be risky for him, no matter how bullish the environment may look. If the horizon is long, the emergency fund is separate, and the portfolio is diversified, then a short-term bear phase should not be that scary. Discipline is necessary in a bull market too. Profit is visible, so blindly buying everything is not right, because an expensive purchase can reduce future returns. Discipline is necessary in a bear market too. Loss is visible, so selling quality investments in a panic may not be a right decision either. This script is not for any stock tip. This is to understand the market language, so that instead of being afraid of the terms, an investor can understand them properly. The next time someone says that the market is bullish, understand that people are optimistic about the future and prices are in an upward direction. When someone says that the market is bearish, understand that an environment of fear, uncertainty, and falling prices is stronger, and investors are becoming cautious. But every expert's word is not the ultimate truth. There are many opinions in the market, but the risk is your own, so the decision should also be taken wisely. Therefore, if you hear bull, do not run in blind excitement. If you hear bear, do not run in blind panic either, because both extremes can cause losses. These two animals of the market give us a simple lesson. A rising market also brings risk, and a falling market can also hide an opportunity. The bull tells you what the power of optimism is. The bear tells you what the value of protection and patience is. A successful investor is one who maintains his balance by looking at both. He neither flies away in a rally nor breaks down in a decline and sticks to his strategy. The biggest game in the stock market is not just of price, but of behavior. Bull and bear are two extreme pictures of that very behavior. Sometimes the market runs up lifting its horns, sometimes it drags down striking its paw, but the investor has to keep his understanding grounded. Because the animals of the market will keep changing, headlines will keep changing, and charts will also keep writing a new story every day. But the investor who understands the meaning, recognizes the risk and maintains discipline, is the one who manages to stand most calmly in the market crowd. Therefore, do not think of bull and bear as just funny names. Look at them as the key to understanding the market language, psychology and cycle. And remember, the real victory in the share market belongs to the person who learns to control both greed in a rally and fear in a decline.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.